Good afternoon, everyone. My name is Mark Brown from Tamimi. Welcome you all to today's webinar on Libor transition. It's a pleasure to have you here all on our webinar. Had a very good reception to the invite, very large interest, which is good to see, and hopefully on the call we're going to have a very broad representation of market participants and also regional participants who had acceptances from people in Jordan, Saudi, Bahrain, Oman, UAE, and more. Banks, regulators, borrowers, investment houses, executive bankers, lawyers, hopefully will be on this call, so hopefully it'll be educational for everyone and there'll be a good contribution. So this is a joint presentation between Tamimi and one of our good friends at Untitled Chambers, one of the leading barristers' chambers in London. The idea behind it being a joint presentation is so we can get the balance of our regional expertise alongside, excellent English law litigation risks which underpin the Libor transition. So today you'll be hearing from myself and Matthew Heaton of Tamimi. We're both senior members of Tamimi's regional banking team. And from out of Temple, we have Justina Stewart, who's a commercial chancery barrister specialising in banking and finance, and a lot of recent litigation and advising on Libor. Now, just a bit of housekeeping for those who are new to the Tamimi webinar platform. You can see us, but we can't see or hear you. Hopefully you can see and hear us. There's a question and answer facility on the dashboard that's provided. So any questions, please do put them into the Q&A facility and we'll be able to pick them up. If there's anything relevant to a slide, we'll hopefully try and address that at time. Otherwise, we'll aim to have some time at the end. We've got approximately 1 hour for the presentation, and we'll do our best to stick to that because everyone's very busy. Now, just to set the scene, why is this important? Why is this webinar important? Why is the Libor transition important? Now, you'll appreciate with all of the people we have online, there might be a spectrum of understanding, so we just wanted to set the scene initially. Libor is a critical benchmark in the financial services industry. In preparing for the presentation, the estimate for products that use the Libor is estimated anywhere between $200 and $400 trillion, and that's globally. But more locally, everyone knows that there's USD billions both in lending and products that are priced using USD and Libor in the Middle East, so it's very much a local issue. Not all Libor products are English law, many are governed by local laws, so again, very much a local issue. All banks use Libor in the region, so a solution to the Libor transition is needed for everyone. At present, there aren't any legislative mechanics here or in many places elsewhere to deal with the transition. And so that leaves really an industry-led solution to the problem in the absence of regulator-led. Now, every bank is different in terms of its products, documents, and customers, and so there's not going to be a one-size-fits-all solution for every bank. And the end game, if there is no fix, then litigation may well be the likely result. And it's gone by 31 December 2021, so time's very tight, and we don't want to, facing a lot of litigation in 2022 isn't necessarily a fun prospect. So just to give an outline of the presentation, initially I'll speak to the background, then I'll pass over to Justine, who will talk about the replacements and litigation risk. Matthew will speak on the tough legacy contracts and typical fallbacks and contracts in the region. Justine will also talk about English law litigation risks, and then at the end we'll try and tie it up with regulatory approaches to the Libor issue and potential way forward. And Matthew will and Justine will speak to those 2 points. So, as we all know, well, how did we get here? So, Libor is hopefully is aware is a market standard base rate for financing and derivative transactions across multiple currencies. We see it every day in lending and derivative documents. It's used for lots of different multiple currencies and tenors, but most importantly for the Middle East region is USD Libor. Now, why is it being replaced? Well, there were 2 key issues. In 2012, there were significant revelations of Libor rigging by reference banks, which led to huge fines in the billions of dollars, and it moved from being an industry regulated rate to a regulated activity. Now, on top of that, Libor actually, in reality, was so thinly traded between banks, no one thought it was actually fit for purpose or reflected interbank lending and true cost. I saw a quote from Mervyn King, the Bank of England regulator, who called Libor the rate which no banks actually lent to each other. So what happened when it became regulated? Well, there was a major reduction in quoted currencies and maturities. It went from being 150 rates of 15 different maturities and 10 currencies to 35. But then 4 years later, the Financial Conduct Authority of the UK, which is the Libor regulator, announced that Libor would be replaced by the end of 2021. So that's where we are, and in that time there's been lots of work to try and introduce alternatives, and on that I'll hand over to Justina.
Many thanks, Mark. Let me just, there we go. Right, so the first thing we need to understand is what are the proposed replacements for Libors. These are what are called risk-free rates, RFRs. I've set out here some of the proposed replacements for key currencies. So for sterling Libor, SONIA, US dollar Libor, SOFR, although I would say there is increasing interest in Ameribor, and it may well be that there are more than 2 replacement benchmarks, just to confuse matters. Right. In order to understand why Libor transition is so difficult and why it's likely to lead to litigation and regulatory risk, it's really important to understand some fundamental differences between Libor and risk-free rates. I've summarised these here, each of which we're going to have a look at, with Mark focusing on the issue of compounding. So, firstly, Libor is forward-looking while RFRs are backward-looking. So what do we mean by this? Well, in simple terms, for Libor, you know what you have to pay in advance. With RFRs, you don't. By way of example, you borrow 10 million on, say, the 19th of August, and the relevant rate, the 3-month Libor, on that date is, let's say, 5%. That means that on the 19th of August, you can calculate what interest you have to pay in 3 months' time by simply applying a standard formula, which I've set out there. With RFRs, it's very different, and that's because RFRs are overnight rates, they're compounded daily and in arrears. For example, looking at SONIA here, SONIA is set in arrears based on actual transaction in overnight index swaps for unsecured transactions in the sterling market. So say that SONIA on the 19th of August is 5%, then the amount owed the next day is 5% of 10 million over 365, obviously, and then you add it to the 10 million. The next day, so the 21st of August, you apply whatever the overnight rate was on the 20 to 21st of August to the total sum owed the day before. And so it goes on a daily basis. And so it's not until after 3 months that you know what you have to pay. Now, market participants are gradually waking up, and I would say gradually, to the fact that this lack of cash flow certainty for all parties means that RFRs may not be suitable for a wide range of products. In fact, in January of this year, the UK's working group on sterling risk-free reference rates, they recognise this. And what we have here is a table from their report of January this year. And in red, what we can see are all those types of contracts, and I don't think we can see them all on this slide, but we can see all of those types of contracts that aren't suitable for RFRs. So they say export financing, lending to emerging markets, mid-corporate, private banking and retail lending, trade and working capital, Islamic finance. Categories are very wide. Now, my personal view is that there'll be many parties in other categories that aren't going to be happy about losing the cash flow certainty that comes with term rates. Irrespective of my views, what is clear that on any analysis, there are many parties for whom RFRs won't be suitable. Now, you might have thought that therefore the most straightforward solution to ensure cash flow certainty for parties would be to use a term rate. But this is far from a straightforward solution. In sterling, there are a number of contenders for the SONIA term rate, each with different methodologies and each with problematic underlying liquidity issues. So we're very far from a market established and trusted benchmark for SONIA term rates. US dollar, perhaps further along. Ameribor is a rate that's already been established. And as I said, many in the market see this as a better option than SOFR. But the thing about Ameribor is further that Ameribor futures are already traded. So term rates can be derived from, therefore. However, there are still real issues regarding liquidity with the trading of those futures. So really the takeaway points are that either there isn't an established term rate in the relevant currency, and even if there is, the irony is that it's likely that be able to far easier, even easier to manipulate than Libor. So you can't assume that there will be a term rate solution. Now, a key issue, as shown on this graph, is that generally Libor exceeds the RFR. In broad terms, that's because Libor incorporates a bank credit risk premium, which the RFRs don't. But not only is Libor numerically greater than RFRs, but also the difference between Libor and its corresponding RFR varies. And that's because they can behave very differently. And that's something that we've seen recently with COVID-related market turbulence. What we also see for RFRs are spikes, which you don't see so much with Libor. And I would add that we have seen much larger spikes for SOFR as opposed to SONIA. So in summary, you cannot just replace Libor with an RFR. You really have to think about what the extra spread should be. So therefore, how do we calculate the extra spread? Well, therein lies the key problem. There is no immediately obvious answer. ISDA's come up with a solution based on a 5-year historic median. The LMA and others may come up with different solutions. Although because different solutions would obviously cause issues in the market, for example, with hedging, it's anticipated that the market may well converge on the ISDA methodology. But whatever the eventual market preference is, any solution is going to be imperfect in that there'll be an inevitable value transfer from one party to another. So there are going to be winners and there are going to be losers. And that leads me on to the next slide. Now, the starting point is, of course, that one party cannot unilaterally vary a contract unless the contract allows this, which, as we know, it very rarely does. Therefore, the parties need to agree to any contractual variation. But there are arguments out there which parties can deploy to cause real trouble. For example, they may seek to rely on frustration or force majeure in order to allege that they're discharged from future obligations under the contract altogether. Or they may use these types of arguments simply to negotiate better terms. And that may well be in the context of a refinancing or a restructuring, both of which we're going to be seeing a lot more of given the challenging economic climate we find ourselves in. Then we have some regional issues regarding compounding, which I'll hand over to Mark to talk about.
Thanks. Yeah, one example of particular regional consideration is the uncertainty of enforceability of compounding rates in Middle Eastern jurisdictions. There's, for example, the UAE in the central bank law, it says that you cannot charge interest on accrued interest, which is a new change in the 2018 central bank law. Given that RFRs are clearly compounding and it's baked into their methodology, it's not clear how that would, if it was before UI court, how that provision of the central bank law could apply to the use of an RFR in a financing contract. In other regions, such as jurisdictions such as Kuwait, it's also unclear how compounding generally would be treated. But this is to note that this is already a present risk in the law. The only thing the Libor transition does is creates a new spotlight for these new rates. Other things to think about is similar to what Justine was saying in terms of being fertile area of litigation. There are things in local law that are equivalent to English principles of force majeure that could also be argued if litigation came to local courts. So the same litigation risks that you could face in under English law contracts, you could face under local law contracts too.
Right. Now, looking at some typical products, we can see why parties may have a very real incentive to exploit potential legal arguments and even ultimately litigate over Libor transition. I'm going to look at some really simplified examples here. Looking first of all at a variable rate loan, so the rate is Libor plus a margin. Now, a standard loan will have the usual financial covenants, interest service, coverage ratio, and so on. Now, consider a borrower on the cusp of breach of financial covenants, and there are going to be many more of these given COVID. There's obviously a real incentive for these types of borrowers, many of whom really will be fighting for survival, to do what they can to get the best replacement rate possible. and so prevent an event of default, or do what they can to mitigate the risk of that. Turning next to swaps. Now, a borrower may have entered into an interest rate swap to hedge the risk of Libor rising. The borrower pays the lender Libor. The borrower then enters into a swap such that it pays a fixed, say 2% rate in exchange for receiving Libor. So as we can see, Libor cancels out, so the borrower is effectively just paying 2%. However, let's say rates have since gone down, so the borrower wants to refinance at the lower rate. But if the borrower wants to, it has to break its swap. So what's the cost of that? Well, as an example, let's say the details of the swap are as follows. It matures in, say, 2025, so in 5 years' time, fixed rate at 2%, current swap rate 1%, notional of 10 million. That leads, in this example, to a break cost of just under $500,000. So if the borrower can argue, as I'll show may be possible, that the contract has been, for example, frustrated, then the borrower can save the break cost, namely a tad under $500,000. And those types of arguments could be used more broadly in a negotiation to restructure indebtedness and hedges. Now, fixed rate loans. You might have thought that the demise of Libor doesn't impact fixed rate loans. After all, the rate's fixed. However, that's not necessarily the case. I've done many cases involving fixed rate loans taken out when market rates were very high. Rates have since plummeted, so companies naturally want to finance before the end of the term of the loan. However, what's often stopping them is banks saying that they're then liable for break costs calculated on the basis of breaking a Libor-based swap. And these costs have often been prohibitive, therefore preventing refinancing. However, again, imagine if the borrower could argue that as Libor doesn't exist anymore, it can't be liable for the break cost. That could enable them to refinance, indeed possibly restructure far more broadly. Now, at this point, I'll hand over to Matthew, who's going to be covering tough legacy contracts and fallbacks.
Thank you. So tough legacy contracts are what is probably of most interest to us here. These are contracts whose tenor extend out beyond 2021 and so the replacement of Libor, but for various reasons they are very tough or tough to vary. So some of these contracts will not contemplate permanent Libor discontinuation, or they will have no fallback provisions at all, so they will not contemplate to have any mechanism contained in them to deal with Libor no longer being available. Some might be derivatives contracts. So whilst the ISDA protocol is voluntary, if those ISDA contracts are being entered into to hedge exposures under loan arrangements, which are themselves tough legacy contracts and facing challenges in terms of amending the underlying provisions, then it might not actually be in the best interests of the counterparty to use the voluntary protocol of ISDA amendments. So it just adds an extra complexity and an extra layer as when we're looking at the overall financing transaction package which might be in place and which we have to deal with. Bonds, some of the characteristics of bonds are that they can be very long dated, so extending way beyond 2021. And they're also very broadly held, so trying to get consent of all of the stakeholders to amend the calculation of interest can be very, very challenging indeed, even if there is a notehold trustee or other person representing the bondholders on something which is such a fundamental change. In terms of loans generally, both syndicated and bilateral, there's such an amazing variety of types of structures. We see in the region here $5 billion loans on 15-page loan agreements, or a $10 million loan on a full LMA. There's such a different variety, and there's also the inherent costs in amending all of these transactions, because each borrower will need its own advice, so there will be legal advice, the management cost involved in amending and agreeing a mechanism by which all of these contracts are going to change. So it's going to be a huge exercise. Similarly, mortgages. Many people who have mortgages might not even be aware of what Libor is, less so that their underlying contract is somehow tied to a Libor calculation. So making those borrowers aware and getting their consent and their approval is going to be incredibly demanding. The legacy contract, the Chapter legacy contract, as I say, could be just one part of a bigger, more complicated and structured transaction. So it might be that all of the different layers need to be amended concurrently to prevent cash flow mismatch caused by the fact that RFRs are backwards looking and other elements, because you will want to make sure, borrowers will want to make sure that they're comfortable with the changes that are being made to Libor when it's being replaced to their overall financing packages, and to make sure that they're able to predict with confidence that they'll be able to meet their obligations. Another consideration, as was mentioned at the outset, the replacement and the process for replacement of Libor for different currencies at different stages. So at the moment, if you have a multi-currency facility, then there are additional complications now trying to analyse the best way to proceed, simply because there is no consensus across the replacement of the various currencies and what will replace the Libor for those currencies. So in terms of typical waterfall, or the waterfall of existing contractual fallbacks, so these are the mechanics that are contained in contracts which contemplate the replacement or non-availability of Libor. Some we see is the lender has a discretion to select an alternative rate, but we can come on to this subsequently about limits there are on the exercise of that discretion. This is something that regulators are probably likely to take an interest in as well, in terms of particularly if this potentially prejudices borrowers and the counterparties, then what are the limits on the exercise of that discretion, and will that be subject to litigation and challenge by borrowers and counterparties? A common fallback is interpolated screen rates, which is obviously determined by interpolation of Libor for a different tenor. But if Libor no longer exists, then interpolated screen rates will also not be readily available, or will not be available. Reference bank rates. In lots of current, particularly LMA style documents, there's a reference bank rate, so that Libor can be calculated by the rate submitted by identified reference bank rates. Going forward, it seems very unlikely that banks will provide a Libor rate. It is clearly the whole point and motivation behind placement of Libor is because it's inherent unreliability. If to the extent that any banks do continue to publish Libor rates, one has to question why, because of the inherent litigation risks that they would potentially face and how they would calculate those Libor rates. So to the extent that there are any banks that are prepared to issue Libor rates, then that will probably increase the volatility of those rates, and question whether that is in the interest of either the lenders or the borrowers, and whether that's something that they signed up to at the outset of the transaction. Historic screen rate, when you look at the most applicable screen rate for the currency relevant to interest period, because screen rate will then be a snapshot now of a period in time prior to Libor being abolished, you effectively fix that what a floating rate into a fixed rate facility. Is that in the interests of the borrower? Is that what any party would actually want to do? And then cost of funds calculation, we will come on to later. And there's a whole variety of issues and considerations inherent in calculating the cost of funds, which is, again, another area which potentially has great litigation risk. So I will hand back to you, Justina.
Many thanks, Matthew. I think one of the key features of these fallbacks for me is that, and this is relevant to the issues I'm going to be talking about in terms of litigation, is that they were drafted not contemplating a permanent cessation of Libor. So they were really catering, the vast majority of them, for blips, couple of days of turbulence in the market, Libor goes offline, with not envisaged that Libor would no longer be available at all. So, 1 minute, my slides are being a little sluggish. Here we go. Right, so types of litigation in English law. So let's assume that a party can't unilaterally vary the contract, or there's no agreement between the parties to amend. What type of litigation might we see in English law? I'm going to look at, well, firstly, will the court step in and help by substituting other machinery? Can frustration be invoked? Is Libor demise covered by a force majeure clause? And what issues arise when one party is entitled to exercise discretion, for example, in a cost of funds clause? And finally, I'll touch on our old favourite, mis-selling claims. So first question, will the court substitute other machinery? So, for example, will it step in and say that Libor should be replaced with RFR plus an extra spread, or a term rate? Well, the leading case on this area of law is the House of Lords decision in Subbrook. And the key part of the decision is this, that if the mode of ascertainment of price is an essential term of the contract, the court won't step in. But if the mode of ascertainment of price is subsidiary and non-essential, it's far more likely to. Now, in Subbrook, the court held that the mode of ascertainment of the price of land was subsidiary. A clause should simply be construed as meaning that the price of land was to be a fair price, which the court could just as easily determine using expert evidence. However, my own view is that it's unlikely that the court will step in using the Subbrook reasoning. Essentially, two reasons for this. Firstly, for many contracts, the fact that Libor is forward-looking may well be found to be an essential element of the contract, and the court may well therefore also find there are no viable term rates. Secondly, in line with the Subbrook line of authorities, the underlying thing being valued, say a piece of land, remains intact, but in our case, the thing itself being valued, namely Libor, has disappeared altogether. So conceptually, it doesn't really work. Moving next, yes, that's probably how we're all feeling, but moving next on to frustration. In my view, this is a doctrine that parties are particularly likely to raise to try and, at the very least, negotiate better terms, or to try and take their luck on escaping future obligations altogether. Now, in summary, a frustrating event occurs if an unforeseeable supervening event occurs, the effect of which is more than transitory and which radically changes the nature of the contract. Now, if a frustrating event occurs, the parties are automatically discharged from future obligations. However, the contract is not void ab initio. And that means that at common law, there can be some pretty harsh consequences. For example, a party couldn't recover sums lent or past payments towards a loan. And it was because of those harsh consequences at common law that this act here, the Law Reform Frustrated Contracts Act 43, was enacted. That applies to most contracts. We talk about English law, of course, here, with some narrow exceptions, one of which may be relevant to many of you in the audience, which is charter parties. But if it does apply, the court has the power to make adjustments to the party's position. But taking a step back, ultimately the takeaway point is that frustration, subject to tight limits that I'm going to talk about, is an example of the common law seeking to do justice as between the contracting parties. Now, that leads me on to 3 key statements of the law on frustration, which I personally find really helpful to have in the back of my mind when I'm looking at these cases. The first of those was in Davis Contractors, and basically frustration occurs whenever the law recognises that without default of either party, so it's neither party's fault, a contractual obligation has become incapable of being performed because the circumstances in which performance is called for would render it a thing radically different from that which was undertaken by the contract. And cutting through the Latin, it was not this that I promised to do. Another statement that's regularly cited is from National Carriers and Panalpina. Frustration takes place where there supervenes an event, again without default of either party, and for which the contract makes no sufficient provision, which so significantly changes the nature, not merely the expense or onerousness of the outstanding rights or obligations from what the parties could reasonably have contemplated at the time of its execution, that it would be unjust to hold them to the literal sense of its stipulations. And now I come to the third and, in my view, key statement on the law of frustration, which really shows how frustrating this area of law is. Now, as summarised by Lord Justice Ricks in the Sea Angel, in order to determine what is a radical change, as referred to in Davis Contractors, we need to take a multifactorial approach. Now, in that case, the judge helpfully gave us a list of what we should include in our consideration. Now, the problem is that this is a very broad list and goes well beyond what we would consider in a straightforward contractual construction case. We don't just look at the terms of the contract itself, its matrix, its context. We also need to look at what the parties had in mind about the allocation of risk, the nature of the supervening event, and then finally and crucially, the judge reiterated that the application of the test can't safely be performed without the consequences of the decision being measured against the demands of justice. So the long and short of it is that it's all rather nebulous. And I have to say, I don't think we envy the position of judges dealing with Libor, let alone COVID cases, trying to determine what constitutes justice. Now, a variety of events have been found to constitute frustrating events, and we've picked out some that seem particularly pertinent to the libel scenario. Supervening impossibility is the most obvious ground of frustration, and that might be caused by destruction of the subject matter, even if not all of the subject matter has been destroyed. So By analogy to our scenario, Libor's been destroyed. Easy. There's also another scenario, is the destruction of something essential for the performance of the contract, even though the subject matter of the contract itself remains intact. Now, by analogy, we could say that the capital sum lent is the subject of a loan, but you can't repay the loan pursuant to the terms of the contract if you don't know what the interest rate is. Another scenario is where the subject matter was to be obtained from a particular source, which then becomes unavailable. By analogy, Libor's a specified source of the interest rate that's become unavailable. And then finally, changing conditions. And particularly relevant is the case of Bankline and Arthur Capel. What happened in that case was that a ship was chartered for 12 months. It was contemplated, although not expressly provided in the contract, that the charter would run from April to April. However, the ship was requisitioned and it was only released in September. But the House of Lords found that to hold the charterers to a September to September charter would be to hold them to a contract which was, and I quote, as a matter of business, a totally different thing. So by analogy, you can envisage a party saying that the permanent removal of Libor is, as a matter of business, a totally different thing to a temporary removal, which, as I mentioned before, is generally what the fallbacks, if they do exist, and many contracts have no fallbacks at all, generally had in mind. So that would all suggest that the court may well find that legacy Libor contracts have been frustrated, but it's not that straightforward. It's important to bear in mind that the courts are very reluctant to find frustration, and there are a number of well-established categories of limits on finding frustration, which are particularly relevant to the Libor scenario. The first key limit is where the parties can, at the time of contracting, foresee the risk that the supervening event may interfere with performance. In that case, the normal inference is that their contract was made with reference to that risk. Although I'd emphasize that if the event was not actually foreseen, then the degree of foreseeability required is actually very high. But back to Planet Earth, applying that to the Libor situation, it's going to be of particular relevance to Libor-linked contracts entered after the FCA announcement on the removal of Libor in the summer of 2017. A party may say that the contract hasn't been frustrated because from that point it was foreseen or foreseeable to a high degree that Libor would not exist at some point in the future. So they took account of that risk when drafting the contract. Now, a second key limit is where an alternative method of performance is possible. Applying this to the Libor situation, a party may well argue that a contract isn't frustrated because an alternative method, say replacement by an RFR plus an extra spread, is possible. However, of course, that may be more difficult to sustain for those products for which a forward-looking rate is important. Say, for example, a mid-level corporate loan. Third key limit, the contract provides for the consequences of the frustrating event. Now, an obvious example of this would be where frustration is expressly excluded, or frustration is by necessary implication excluded. If, for example, there's a clause that specifically addresses that risk. However, the key point here is that these types of clauses are construed narrowly. Particularly relevant is the case of Metropolitan Water Board, where it was held that the contract was frustrated even though the events that happened were literally within the delay clause. And that was because, so found the court, that the clause was intended to apply to temporary difficulties, but did not cover the case in which the interruption was of such a character and of such a duration that it vitally and fundamentally changed the conditions of the contract and could not possibly have been in the contemplation of parties when the contract was made. So applying this to the Libor scenario, even though there may be fallbacks dealing with non-availability of Libor, the court may well still find that the contract has been frustrated because those fallbacks were never intended to deal with permanent frustration, cessation, sorry. So, next, what about arguing that Libor removal constitutes an event covered by force majeure clause? Now, there's a whole range of force majeure clauses out there. So the takeaway point is that construction's key. You've got to look at the clause in front of you in the context of the contract. But generally, if you can argue force majeure, in our scenario, the obligations under the contract would be extinguished, or the clause may provide, for example, for the right to terminate on terms. But the real difficulty with these clauses is going to be determining whether Libor removal is in fact covered within the definition of a force majeure event in the contract. Now, because it's a matter of construction, we can only make some general points on whether the clause is likely to include Libor as a force majeure event. It's less likely if, for example, the court holds that there were reasonable steps that a party could have taken to avoid or mitigate the event or its consequences. So the argument here is that could the parties have agreed to an alternative benchmark? It's also less likely that the force majeure clause will apply if the removal of Libor was predictable at the time the contract was entered. So the same kind of issues that I've already raised in relation to the FCA announcement in 2017 apply equally here. However, the force majeure clause may cover Libor removal if, for example, the clause provides for a number of events specified in the contract, followed by a catch-all like or any other causes beyond our control, matter of contractual interpretation, or a party is prevented from carrying out obligations or is unable to do so, although this is less likely if it can be shown that performance could have been affected in an alternative manner. So again, you're looking at the question of whether the contract could be performed using an alternative benchmark. That said, if the parties are relieved of liability if they are hindered or impaired from carrying out their obligations, then that can have a wider scope than prevented. So it's more likely that Libor will be found to constitute a force majeure event. Now, turning to problems that can arise where one party has the power to exercise a discretion under the Libor reference contract. There are two immediately obvious areas where this can arise in a loan scenario. Firstly, the lender is entitled to replace Libor with a rate in its discretion. Secondly, the contract provides for a replacement rate, which is the cost of funds, which the lender has the discretion to determine. The question, as Matthew pointed out, then arises to what are the limits of the exercise of the lender's discretion. In particular, does the wording impose what's called a braganza duty on the lender, or is the lender held to an objective standard? In short, and at risk of oversimplification, a braganza duty implies limits on the permissible exercise of the contractual discretion. In particular, it has to be exercised in a similar way to an administrative power in public law, which the long and short of it, that means that the lender has to take into account relevant matters, ignore irrelevant matters, and can't make a decision that no reasonable person acting reasonably could have made. However, if a decision maker is being held to an objective standard, the question is what a hypothetically reasonable person in the lender's situation would decide. Now that sounds like a real mouthful. We could have a whole hour on this topic alone, but the two takeaway points are this. Firstly, the question of which standard applies is a very fertile ground for litigation. I've got 4 cases on the go on this area of law at the moment. And we can see this is illustrated alone in these 2 cases involving ISDA. And secondly, and crucially, while on first glance the 2 tests may appear very similar, the question of whether there's been a breach of contract by a lender and, say, determining what the replacement rate should be may well be highly sensitive to which of the tests in fact applies. So great care is required by the lender in determining how to exercise its discretion and therefore avoid litigation. Looking at the costs of funds fallback, there are lots of variation of costs of funds fallback out there. The problems with these can be illustrated by the LMA standard clause. Cost of funds is that which expresses a percentage rate per annum, the cost to the relevant lender of funding its participation in that loan from whatever source it may reasonably select. Quite a few issues on this. Firstly, the borrower is now exposed, whereas it wasn't before, or wasn't so greatly exposed, to an increase in the credit risk of the lender itself. The borrower may not like this at all. Next, that loan. How will the bank evidence the cost of that particular loan in question? You can imagine the practical difficulties. Many banks use a basket of sources of funding, vast number of loans, and various hedging strategies. So in short, and certainly this is the feedback that I've had in the market, is that the banks just don't have the systems in place to calculate the cost of that loan. So how does the borrower know it isn't being charged for the most expensive source or an overly expensive source? More widely, there may be some issues regarding disclosure of banks' confidential information and also even competition law issues. And then last but not least, there is of course the knotty question of whether the lender is subject to a braganza or an objective standard in determining the cost of funds. So, takeaway point, a borrower could cause real problems by challenging a bank's cost of funds determination. In terms of areas of litigation, what we cannot forget are potential mis-selling claims. And these are particularly relevant to libel reference products issued since the FCA's announcement in 2017. Banks or advisors may well find themselves subject to mis-selling claims on the basis that they knew or they ought to have known about the demise of libel, but failed to highlight risks associated with this to borrowers. Perhaps it will be alleged that they failed to insert robust fallback clauses. Turning very quickly to the regulatory implications, in the US and UK, the regulators are all over libel transition, focusing on not least on conduct risk. The banks need to take reasonable steps to treat customers fairly, so customers can't be worse off with a replacement rate, and any communications to them regarding contract amendments need to be clear and not misleading. Governance issues they're focusing on. They're pointing out that insufficient preparation by banks could impact the safety and the soundness of the firms themselves and cause harm, therefore, to the clients and markets. They want to ensure that banks stop issuing libel-linked products as soon as possible. All of this leading to significant enforcement and litigation risk for financial institutions, which the regulators are, of course, only too keen to highlight. Now, unsurprisingly, given the enforcement and litigation risk, there have been increasing calls for legislative protection and assistance. Nothing concrete yet. March 2020, the AARRC proposed statutory intervention for legacy contracts governed by New York law. And that includes providing proposed immunity from litigation if a recommended substitute's used. And then just last month, in fact, it was the end of last month, very recently, the UK's working group recommended a similar approach to the ARRC's proposals for contracts governed by English law, which they would like to see extended beyond just sterling Libor, and which they've also very sensibly recommended that there be cooperation across jurisdictions. But legislative intervention is far from guaranteed in such a short time. So banks really do need to focus now on active transition. That's the message that's coming through from the regulators. I'll now hand over to Matthew to talk about some regional implications.
Thank you. Let's go to the next slide. I think whilst I'm waiting for the slide to change, this is actually quite useful in terms of the contrast between some of the issues we face locally and some of the more internationally focused regulators, where they seem to be a lot more advanced in their discussions and preparation for this. So one of the, as we're all based in the MENA region, that despite there being a lot of cooperation, a lot of the countries are very close. Each country has its own regulatory regime, and indeed many countries actually have several competing regulators. So just adding to the complication of trying to agree a way forward. We did, ahead of this webinar, we did an informal survey of colleagues and some clients, just to get an idea across the region about whether the extent to which local regulators have been giving any direction on this. And I think it's fair to say that so far there's been very limited guidance. Seems to be that there is a limited engagement so far with borrowers as well. We've had certain transactions where borrowers have been aware of this, other borrowers haven't. So this is just adding to the potential for bottlenecks, because there will have to be a great deal of education and engagement in order to move forward and reach agreement on this. And at the moment in our region, it seems that there isn't quite the awareness of how little time we've got and how much work we actually have to do. Justina discussed some of the obligations of fairness, which the regulators in UK, US and Europe in particular compel financial institutions to adhere to. They are less explicit in the MENA region, with regulators typically having more discretionary powers. That adds to a certain amount of additional uncertainty about or increased uncertainty in this process. As we're all aware, regulators here can often issue laws, regulations, rules on quite short notice and haven't necessarily always taken soundings, or people haven't always input in the way that they might do elsewhere. So again, it is this need to actually engage, which is crucial. It'll be interesting to see whether the regulators in the region follow on the coattails of the US and UK, or set out their own requirements. As Mark said at the outset, Libor is key in this region. There's an awful lot of dollar trading. A lot of the currencies here are pegged to the dollar. So this is something which is of fundamental importance in this region. Picking up on the point that there are so many different jurisdictions and so many different regulators, if there isn't a coordinated or regulatory intervention or agreement with the clients, what will the legal fallbacks be? I think that's a complicated question because there are so many countries involved here. A lot of our clients, both banks and borrowers, have operations across the MENA region, and so we'll be facing the additional challenges of dealing with these issues across a number of jurisdictions simultaneously. Will always obviously also add to the complication of this process. And there's also, as a consideration, the impact of the prudential position on the banks, the transition away from Libor might have. So the overall message on the regulatory implications as MENA is that there's a lot to do, and I think so far there has been limited guidance from the regulators. So this takes us on the way forward and what to do. It's obvious that there's an awful lot of time, an awful lot to do in very little time. Justina and I were discussing this before we came on, that the COVID situation, the COVID pandemic, has caused issues and delays in terms of the focus on this, and also the ability of borrowers and regulators and banks to focus on this. But it's been made very, very clear that there will be no extension to the deadline for the replacement of Libor. So we are working towards a hard deadline. We are advised to our clients, whether they're borrowers, whether they're banks and other financial institutions, is to engage with local regulators, but also work to make sure that your clients are aware of what is coming in terms of reaching out to borrowers, and also having training and awareness internally so that everybody is aware of the issues and it's aware of what actually needs to be done. Linked to that will be a rollout of client engagement. We are coming, we're halfway through 2020 now, so the clock really is ticking on this. Something we have been doing with our clients is helping them undertake a preliminary review or audit of their portfolio and documents. One of the first steps for clients, both lenders and borrowers, is to try and get a sense of the scale of the task, try to understand the form of documents that they have. Over time, lenders will have accumulated various different forms of documents with different provisions in there. So it's important just to have an idea about what needs to be done, and obviously agreeing a house policy on this and trying to implement that. There's lots of resources for updates which are available for people to subscribe to, so that they are aware of updates as they become available, and some of them are listed here. But we would be very keen and very willing to speak to you to help on this process and to start putting in place plans to enable you to roll out the plan to lead towards the replacement of Libor at the end of next year. So, thank you.
Yeah, thank you, Roy. There's one question that we've got in from one of the attendees. That question is, will there be a move to Sharia compliant financing because it removes all of the Libor issue? So I'll take a first pass at this, and if anyone else wants to chip in, please do. I think that the short answer to that is no, and that's because there are a lot of Sharia products that actually use, where they're priced in USD, they actually can use Libor in the calculation of profit rates in Murabaha transactions, for example. And also Sharia banks, one of the points on the slides was about you know, your prudential position. If you're using a very complicated pool of swaps to manage your regulatory requirements, it'll be guaranteed that there'll be Libor pricing in a bank's for a bank's credit management or capital control management. So I think from my perspective, I'd say no. Libor will impact on Sharia financing, and also, you know, if people are thinking about refinancing, it's still a job to do the refinancing, whether you move away from your existing Libor term product to a Libor RFR product or to a Sharia compliant. it still requires you to engage with borrowers. So in that way, it just adds another choice, but it doesn't remove the problem. So another couple of questions. First one is, what will the LMA's role be in the region? Do you believe it will be adhered to by the parties as a fairly standard fix? Matthew, do you want to take that one?
I think it will play an important role because the LMA is widely recognised as one of the leading organisations of the loan market. And I would imagine that once the LMA has helped form consensus on Libor replacement generally, then the sheer scale and quantum of loans that it will represent will mean that it will be very powerful and very influential in the region as well. It clearly will not be directly applicable, but I suspect that, as with most things, there is a willingness and a desire to follow their lead.
Yeah, I think that's certainly what I've been seeing. LMA very much focusing on their primary markets first, but also with some of an eye to the wider consequences. And they are proposing language that is applicable to their LMA standard documentation as well, which is fairly commonly used in the region. Another quick question was, is there any development with respect to EBOR? That's the Emirates Interbank Offered Rate. The short answer there is no. So that's a nice and easy one. Next question was, what about, there's a question here for, what about the valuation for financial institutions for future due debts, say if there was a loan made in 2016 and due in 2022? So I think the underlying question there is, well, how does that impact on the value of that debt, if I guess for the lender? I suppose that would be very much driven by the rate that was used in the initial debt and what it was replaced with. Justine, I'm not sure if you have further input on that one.
Yeah, the various accounting bodies around the world are trying to get to grips with how exactly you do value, with varying degrees of success. So because there is so much uncertainty, basically. So the bottom line is, look at whatever accounting standards are being applied to your situation, see what the relevant accounting body is saying about that, and go from there. In terms of what the actual value is, well, as we know, valuation is can be quite a mystical operation. So, yeah.
Great. Well, that's there's no more questions on the panel at the moment, so unless one comes in the next couple of seconds. Just want to thank everyone that's still online. Thank you for listening and for your questions. I hope it was helpful and useful for all of you, and either continues the conversation or starts one. And and thank you all for attending.
Thank you very much.
Right.